Now that we have an understanding of the two phases of the market and how they create the two trends that we see in the market, both the bullish and the bearish trends, we need to understand how to quantify a break of structure, or more specifically, what even is a break of structure. We talked about it or briefly mentioned it when we discussed the trends of the market, but we didn't really indicate how do we confirm a break of structure. So firstly, a break of structure indicates that a previous level of market structure has been broken. This can indicate that a trend is continuing higher in a bullish market or lower in a bearish market. In a bull trend, a break of structure happens when the previous high is broken and a new higher high is likely to form. And in a bear trend, a break of structure happens when the previous low is broken, forming potentially a new lower low. So how do we confirm these breaks of structure? A structure break is only considered valid if the price breaks and closes above or below the level in question. So if we're looking at a bullish trend, a break of structure is only valid when there is a break and close above the previous high. So if we look at this example right here, we have our previous high, and we can see that price is just breaking the structure here. If we look into this little bubble here, what we want to see is that price breaks and closes above the previous high levels. Now, what would be an invalid break of structure is if price simply wicks above the previous high but does not close above it. So if we look at these two candles, we can see that this candle's close price is above the previous high, where this candle's close price is still below the previous high. And if we flip to a bearish market where we're seeing lower lows and lower highs, we have our previous low and our break of structure potentially happening. What we want to see is a break and close below that previous low. As we can see, the closing price is below the previous low, and an invalid break of structure would be the wick of the low of the previous low. And as we can see, the close of this bearish candle is above the previous low that we're looking to break. So simply seeing that price wick the previous higher low is not enough to justify that structural break. Now we can take things a bit further and have an even more stronger confirmation that a break of structure has actually happened in the market. And this is where we're going to introduce the concept of the hard close candle confirmation. A more definitive way to gauge and confirm a break of structure is to wait for the level of structure to be hard closed, or print a hard close candle. This extends the break and close of a structural level and gives the break of structure so much more conviction. A hard close candle, in the simplest terms, is a candle within trend that closes outside of the previous structural level. The candle open, simply put, must trade above the high or below the low to be considered a correct hard close. So the idea behind the hard close candle is that when it prints, fractally all timeframes below that timeframe have closed above or below the level of market structure that we're looking to confirm that has broken. So let's take a look at a bullish example, a break of a previous high, and confirm this break of structure with a hard close candle. So what we can see is we have a previous high denoted with this line. Our first candle breaks and closes above the previous high, but is not a hard close candle. The next candle, however, is considered a hard close candle. And the reason why this is a hard close candle is the open of the bullish candle is above the previous high. So this showcases that all timeframes below this timeframe have closed above this structural level. Now, this is an extremely powerful confirmation that all of the timeframes below it have closed above the previous level, which make the break of structure that you're trying to validate, this break of this previous high, even stronger in confirming that price has in fact broken that structure. Now, simply put, if we're looking in a bullish market and we're looking for that hard close candle of that previous high, we want to see a bullish candle that opens above the previous high, if we can put it in the most simplistic term of what a hard close candle is. So a previous high, the candle that opens above the previous high would be considered our hard close candle, so long as it opens and closes above that high. Now let's just take a look at what a hard close candle is not. That way we can delineate the difference between the two. So in the same example, we have a previous high, we have a break and close above that candle, which would be our initial confirmation that we've broken structure. Now the next candle that prints is a bearish candle that opens above the previous high and also closes above the previous high. Now, the thing to note is because this is a bearish candle, this would not be a hard close candle. Even though it's closed above the previous high and opened above the previous high, it's not bullish, therefore it's not a hard close candle. This next candle that opens above the previous high and closes above the previous high and is bullish, most importantly, is confirming and is a hard close candle, confirming that the previous high has now officially been broken. Now let's just take that, flip it, and talk about a bearish trend where we have a previous low and we are trying to confirm that the low has in fact been broken using the hard close principle. So if we have this, we have our previous low, we have a candle that breaks and closes above, which would be our initial confirmation that we've seen a break of structure. If we want to confirm it with a hard close candle, we would wait until we see a candle open below the previous low and also close below the previous low, and most importantly is still a bearish candle. We want candle closures that are in line with the trend in which we are trading. Now, if we again look at another example of what a hard close candle is not, we can see that we have a previous low, we have a break and close below that, which is confirming the initial break of structure. We want a hard close candle confirmation to give us that extra bit of confirmation that the previous low has indeed broken. The next candle is a bullish candle that opens underneath the previous low and closes underneath the previous low. But because it is a bullish candle, it is therefore not a hard close candle. The next candle that prints is a bearish candle that opens below the previous low and closes below the previous low, which confirms that the structure has indeed been broken and we have hard closed below the previous low. And again, the concept of the hard close candle is just to confirm that all timeframes below that previous low have actually closed below the previous low. And it's that extra confirmation that a break of structure has taken place in the market.